With recent market falls, people are rightly worried whether the stock market is about to crash. Well, let's have a look at the state of over or undervaluation. I've got some data in front of me I'm going to share with you. Since the post-pandemic stock market boom, analysts and experts have warned us that the market was overvalued. So they've been saying it for quite a long period of time, and yet it kept hitting all-time highs. Those who waited for it to pull back have often missed the train as it continued rattling down ever upwards, okay? So some have gone even further and submitted that we're in a bubble that's about to burst. However, prices keep rising, suggesting many investors believe there is still value to be found, or at least momentum to be ridden. So which is it? Is the market over or undervalued? Let's look at the case for an undervalued market first of all. Whilst the S&P 500 has hit record values, since the stock market dropped during the early stages of coronavirus, the FTSE 100 has yet to recover. The drop of around 14% left a long way back at the time, or at least felt a long way back at the time. However, values have steadily increased by about 5%. So as you can see, the FTSE has had a long way and still has a long way to go. A successful vaccine rollout and easing of Brexit anxiety at times, only for it to return, have made a big difference during those moves upwards. In fact, for the first time in 5 years, investors are equal weight on the market. However, despite all of this, the market remains at a significant discount. According to the broker Peel Hunt, the 12-month forward PE is 25% cheaper than the Eurozone and 40% cheaper than the US markets. So all things being equal, it seems like Brexit economic fears still exist, or fears of some kind, at least in the FTSE 100. The case for the US stock market being undervalued may be more challenging to make, primarily because it keeps hitting all-time highs and even now is only off about 6% from its all-time highs despite recent sharp falls. However, some analysts believe bad maths and mistaken presumptions are behind doomsday predictions. In fact, John S. Tobey writes in Forbes that instead of using the PE ratio, we should use the earnings to yield ratio to value stocks. He firmly believes that if we make this adjustment, the market is indeed undervalued. What about the case then for an overvalued market? As always, there are plenty of voices who believe the market is overvalued. Additionally, two reliable measures of the market suggest the market is overvalued. First, the Shiller PE ratio stands at 38 times. The number is close to the peak of 44 that it hit during the stock market boom. Strategists at Sundial Capital Research have said that historically a number over 25 is a precursor to significant market corrections. However, they have stopped short of issuing sell warnings. The second valuation metric that is given out as a warning sign is the Buffett indicator, which takes the Wilshire 500 index, the Wilshire 5000 index, a very broad index of 5,000 stocks, and divides it by annual GDP of the United States. It currently stands at 238%. To put it into context, the value was at 159% before the dot-com bubble. However, it's worth noting that this time might be different. Don't we always say that? Because interest rates are at historic lows, and that does affect the indicator. So what's the conclusion? It isn't easy to draw concrete conclusions about the market, is it ever? In ways, it has been defying all predictions since the COVID bounce back. While there are some fears about the Delta variant, about red list, about the virus resurging again, in actual fact, the virus rollout has been successful. Low bond yields and good earnings reports have kept money flowing into the markets. Those aren't really changing. There is a little bit of a spike up in bond yields, but nothing like what we saw during the financial crisis. If tourism and travel fully return, well, we'd expect the positive news to continue for a while. For me, I'm keeping hold of the less volatile stocks, so more of the less volatile stocks. The larger cap companies. I have no problems holding tech companies. I know there's some profit taking going on, but I look at my longer term time horizon. So in this environment, yeah, I still want companies with strong earnings, strong revenue growth, strong cash flow. But increasingly important for me is lower volatility in those stocks. And as I said, I'd rather have some of the larger cap than the smaller cap because of volatility concerns. Anyway, this is all part of my campaign for $1 million.com to help teach 1 million people how to be better investors. I hope you found it useful.